Today, we're happy to have our guest speaker, Sandy Yong, investor, speaker, and author of Money Master, as we discuss how to start investing on a budget. Hi, Sandy. Thanks for joining us today. How are you?
I'm great, Ivy. How are you?
Good, great. Can you please just tell me a little bit more about yourself or to the audience today as well?
Sure. Yeah. So for those of you who don't know me, I did graduate from Ryerson University here in Toronto about a decade ago during the economic recession. Fortunately enough, I did land a full-time job working within the hospitality and tourism industry. And while I was working, I realized that I needed to save for life big milestones, such as saving up for a dream house, a car, a wedding, and then eventually retirement, like most Canadians. And so that's where I decided to learn about how to invest. And unfortunately, when I first took a stab at it, I lost thousands of dollars investing in mutual funds. And that's where I realized that I needed to take matters into my own hands and educate myself. And that's where I became a self-directed investor, created a six-figure portfolio by the age of 27, wrote a book about it, and now I'm helping to teach millennials on how they can also create wealth through investing.
Great. That sounds like a very exciting. So Sandy, our topic today, not surprise, is how to start investing on a budget. Was this something that you had also encountered when you first started investing?
What I first started out doing was I tracked my income and expenses. So I would recommend, for those of you watching, you can use a simple note-taking app. I personally like to use Evernote. And what I do is that I create a template, and I've got different categories. I've got my income, my expenses, also savings and investments. What I find most interesting is tracking my variable expenses from month to month. And this is where, whether I go online shopping or in-store shopping, whenever I make a purchase, I simply open up my note and I write down the date, the name of the store, and how much I spent on that particular item. And then at the end of the month, I can see a full summary of how much I've spent and where my money has come in from and where it goes to.
Great. So Sandy, I'm curious to know, so for new investors, why do you think it is important to keep track of income and expenses? Is there any specific steps that you take to do this? And how detailed do you usually get into it?
Yeah, so I find that it's one of the most simplest and quickest exercises for people to get their feet wet. And by doing this, it really shows what your lifestyle is and what your spending habits are like. For example, when I went through this exercise, I looked at the past few months, and then I realized that most recently I've spent the most money on food, whether it's dining in, well, not dine in, but takeout, groceries, as well as clothing, and now home decor, even home renovations. And now that I've been able to assess this and I have this knowledge, I'm able to kind of tweak that. And so most recently during this pandemic, like a lot of us, I have been working from home. And before, when I had to go in the office, I would buy professional outfits. But nowadays, since we're working at our house, I find that I've been able to save money and maybe buy different brands. And so from that, I've been able to either direct it into another category or even boost up my savings.
Mm-hmm. Great. And would you say you keep those very detailed when you do keep track of those income and expenses? How do you keep track of them?
Yeah, so the next step would be that I would take all that information and I put it into a monthly budget. And you can easily do this by looking into getting a budget template, and there's different categories. So in a budget, you've got your income sources, and this is where you want to ask yourself, where does all my money come from? For most people, it could be from their full-time employer, or maybe some people have their own part-time business. Others, they have rental properties, or maybe they get an annual bonus or some type of commission, or even government funding or family support. Then the next area you want to look at is having an emergency savings fund. And this is quite critical during the times that we're living through. And the typical advice you hear is probably to have between 3 to 6 months of expenses saved up. But I would personally even suggest having maybe 9 months or even up to a year because of the uncertain times that we're in. Next, you want to ask yourself, what type of savings goals do I have? For some people, they might want to save up for an annual vacation, or maybe a new laptop, maybe a new winter jacket. Whatever your goals are, you want to be able to ensure that you're saving towards those goals. Then the next part is your investments. And this is where, for most people, it would be looking at maybe investing for their retirement. And the most common investment vehicles would be the TFSA and RRSP. Then lastly, we've got our expenses, which is your fixed expenses and variable expenses. But the major categories would be housing, transportation, food, entertainment, clothing, medical costs, insurance, maybe even monthly subscriptions, and so on. Then what you want to do is write down all of the information where you spend your money and all the income sources you have. And you would calculate, you would take your income and minus all of your expenses and everything. And then at the end of the month, you'll see whether you've got a surplus of money or maybe a deficit. Now, if you've got a surplus, this is fantastic. That means you are spending within your means, and you might even want to take that extra money left over and boost your savings or eventually your investments. However, if you have a deficit, it means that you are spending more than you earn, and you'll have to find ways to tweak your spending habits to ensure that you are spending within your means.
Great, great. Now, you mentioned, and correct me if I'm wrong here, because it sounded like at the end of this, investors would have some sort of idea of what their net worth is, after taking consideration of the income and expenses, and you would know exactly how much your net worth and financial picture. What would you say that the next step would be?
Yes, in terms of calculating your net worth, it's a really great way to measure your financial success. And for some people, it's a way for them to measure how far away they are from retirement or even having that financial stability. And it's a simple formula. It's simply taking your assets, minusing your liabilities to get your net worth. So for example, some assets could be your house, or maybe you've got some artwork or jewelry. Obviously, you've got some of your investments saved up. And then on the other side, we've got the liabilities. It could be an outstanding student loan, car loan, credit card bills, some type of line of credit. And so when you do this simple formula, you will be able to see how much your net worth is, and you can measure your success that way.
Great. Now, I'm curious, and this is not only for the investors out there, but also for myself, from a perspective of new investors. How important do you think it is to set financial goals?
I think that it's one of the most fundamental steps that people may tend to overlook. But this is a really great time to sit down and reflect, whether it's by yourself or maybe with a family member or significant other, to think about what kind of future lifestyle do you envision yourself having? And by really taking the time to see what kind of lifestyle you want, then that way it will determine what your plan or what your roadmap will be. So you can ask yourself the following questions. One, what do I want to achieve in life? Like, for example, some people who are married with kids, maybe they want to have that dream house, maybe live in the suburbs and whatnot. Or maybe if you're single, you still have that, the hunger, the appetite to travel the world, maybe even work remotely. And so these different motivating factors will help you figure out where you want to be maybe 5 or 10 years down the road. And then you have to see how much money do I need to achieve these goals. Because let's say, for instance, if someone wants to purchase a car, well, a price of a car can be substantially varied in the market depending on, say, whether you drive a Honda versus a Porsche, right? And then lastly, when do you want to achieve those goals by? And this is where you want to give yourself a timeline or to set a date of when you want to achieve those goals. So for example, let's say, the cell phones are really hot right now in the market. And let's say a year from now, I want to purchase the latest iPhone and it's $1,200. What you can do is you can break this down into a more manageable or achievable goal. And you can say, I will save $100 for the next 12 months so that a year from now, I can purchase the new iPhone model. And it's and as you go along, you can monitor and adjust your goals. Sometimes there might be roadblocks along the way, and it's also a great idea to share your goals, whether it's with a significant other or maybe even a friend, to share that accountability, and then that way you can help support each other to achieve those goals.
Great. And I'm not going to lie, I find myself to be a huge goal setter as well. Sometimes it may take a little bit longer, but I love the point that you mentioned about, setting SMART goals, having a timeline, making sure that it is realistic, measurable, and clear. So I absolutely love that. Now, specifically for investors starting on a budget, what are some ways that you suggest that would maybe help them save or achieve towards their goal?
Sure. Yeah. So there's many ways that an individual can save, but I will share my top 3 tips. So the first one is to automate your savings. And you can simply do this by going into your online banking account. Then you can set the amount of money that you'd like to transfer. And typically it's from a checking account where you receive your paycheck from your employer. And then you can transfer that money over to a savings account. And then you can also set the frequency or the reoccurrence. And what I would typically suggest is to set the automated savings transfer on the day that you get paid by your employer. So let's say biweekly on Fridays. And then this way you are creating that habit or that typical advice of pay yourself first. And then that way, when you set aside money for your savings from the get-go, soon enough, you won't miss that money, and you'll know that you've got even a rainy day fund. And then another tip that I suggest is creating separate savings accounts. So I think majority of people have a savings account, but another great way to take this even further is to create a savings account for each savings goals that you have. So in the exercise that we just talked about creating financial goals, you can have, say, 3 savings accounts. One could be for travel. So let's say a vacation to Japan, and it's $3,000. Your second savings account could be a down payment for a car. Let's say it's $5,000. And then the last savings account could be saving up for a smart home system. Let's say that's $500. And so by creating these different accounts, you can separate the goals and you can track them much better. And that way you're not tempted to kind of dabble into the account and veer off your target. This way you're able to see very concisely how close you are to achieving those savings. And then lastly, I know that this might make people feel a little bit uncomfortable, but my last tip is to don't save your credit card information on your web browser. Now, going through this pandemic, we are seeing the popularity of online shopping, and it's becoming very mainstream as people order clothes or even groceries online. And we see Canadians are choosing click and order over brick and mortar. And as much as technology is fantastic, and it's making it very convenient for us, it's so easy to just do like one-click shopping, and then all of a sudden you've got packages arriving at your doorstep, and then sometimes even wondering, like, what did I even order in the first place? And so this is where I would suggest to have that willpower to remove that autofill credit card information from your web browser. Then that way you have to physically get up from your chair, go across the room, grab your wallet, and enter in the digits of your credit card. But at least in that short amount of time, you have a moment to reflect and ask yourself, like, do I really need this item? Is it that critical that I need to buy it today? Maybe it's something that I can hold off and wait for the future. And so it's just a good practice for us to stop and reflect. Do we need to make the purchases right now at this time?
Great. No, it's interesting that you mentioned the last point. I sort of have to reflect myself on that as well. So for investors with a specific time horizon, and I know we've mentioned the importance of goal setting. Any thoughts on how goals should be set, specifically when it comes to time frame? So, for example, is there a difference between a short-term versus a long-term goal? What are your thoughts?
Yeah, so in terms of creating goals, there are different categories. And I don't know if you've ever created a vision board or a dream board before, but this is an activity that I really recommend. It's fun. Basically, you cut out different images of the things that you want to attract in your life or the goals that you want to set, and then you paste it on a poster board. And there's different categories, whether it's figuring out what is your dream home, or what kind of car do you want to drive, to what kind of destinations do you eventually want to visit around the world once these travel restrictions are lifted. Maybe some of you want to go back and upgrade your skills or education. Or maybe you want to start a family or to adopt a pet. Even things like charity. Some people really want to volunteer and give back to the community, or maybe financially they can donate some money. Then there's things like health and wellness. How often do you want to exercise at the gym, or maybe you want to achieve, certain fitness goals, or you want to eat healthier. And then there could be things like hobbies. Maybe some people enjoy reading or knitting, and maybe different types of sports. And then, of course, there's retirement and figuring out those goals. And then in terms of goal setting, there are short-term goals, which maybe you can probably achieve within a year. And then midterm goals could be about 3 to 5 years. And I'd say maybe 10, or even longer than that could be long-term goals. And I think for a lot of the audience members here, if you look at short-term goals, it could be something like a home renovation. Like for myself, most recently we did a kitchen renovation. So we had to set a budget to figure out what items we needed to replace and how much they were going to cost, and then save up money for that to hire a contractor to help us. And then long-term, it could be for I guess also for majority of people is retirement, and figuring out how much money you need to save for your retirement, and not just solely relying on, say, a pension or RSP or TFSA. Maybe for some people, they need additional savings and investments on top of that to fulfill their lifestyle and their spending habits down the road.
Mm-hmm. That's great. That's great. Very specific. Now, my next question to you would be, it sounds like, because we've chatted for about 20 minutes, it sounds like every investor will probably have a different financial goal depending on the life stage that they're in. Now, how would an investor, if I were to take either myself or the audience today, how would they actually figure out their own investing style and profile?
Yeah, so in terms of determining their type of investor profile they're at, for some people, they might feel that they have tried to enter into the stock market and they've been burned by it, maybe through the past decade or so, and they might be fearful of trying to get back in. Or maybe some people, they have a strong stomach and they're able to weather the ups and downs of it. And it's really understanding your own personality, and it's okay to feel all these different feelings. Like, everyone is unique. And then, so by understanding what your investor type is will help to shape your investment portfolio.
Mm-hmm. Now, along the same lines, so for an investor, if I were to, for example, look at myself, is there any specific things that you look at? So, for example, is there maybe a time frame, risk, things like that? Is there anything specific that you look at?
Definitely. So one of the things that I first look at is understanding the time horizon that I have. So and this is really all it is setting a date of when you want to achieve your financial goal. And let's say it's retirement. So for some people, maybe retirement is still a few decades away. Maybe you've got three or four decades ahead of you, and so it's a long-term goal. But then for some individuals, they might be retiring soon, maybe in the next 5 to 10 years. So their investment portfolio may look very different. And then also, it's important to understand what your risk tolerance is. And this means that you could either be a conservative investor, or you could be a moderate or an aggressive one. And generally speaking, if you are someone who is younger, say if you're in your 20s or 30s, you could have a more aggressive investor approach. And that's because, generally speaking, the theory is that you've got decades ahead of you to weather the storms, the ups and downs of the market. Whereas someone who needs to retire in a couple of years, they may want to take a more conservative approach. And that's because they'll need to start withdrawing funds a few years away in order to fund their lifestyle. But I think really the key thing is that it's understanding what your comfort level is. Because for some people, when they log into their online brokerage account and they see that their portfolio is in red and it's like negative 10, 15%, they get really scared, and they might lose sleep at night. But then for other people, when they see the stock market plunging, they get really excited because they realize that, hey, maybe this could be a great opportunity to buy stocks at a quote unquote discount. And for them, they're able to maybe take on some bigger risks, but then get the bigger the rewards. So by understanding these factors, it will help to determine how to create your portfolio and to achieve the results that you're looking for.
Great. Honestly, I love the fact that you mentioned that investors, and I think sometimes, even if I think about myself, we tend to think a little bit more too positively about the market, and sometimes we tend to overlook the actual risks involved. So I think that's great. Now, is along the same line. So is there a difference in maybe what one should be investing based on their investing style? So let's just say if I'm maybe a conservative versus a moderate type of investor, would I be investing in things that are different? What type of assets do you typically go into?
Yeah, so for someone who's more conservative, or even an individual who is just starting out, you might want to consider a more conservative approach to work your way up. Typically, a conservative profile would hold a different amount of stocks and bonds. And so this is what we call asset allocation, where this is where you can adjust how many stocks versus bonds you have. But a conservative investor typically would have higher amount of bonds than stocks. And then for someone who maybe has a bit more experience, or they've got a long time horizon, they could take on a more aggressive approach where they have more stocks in their portfolio and less bonds. And this is because when we look at the history of the stock market for, say, the past 100 years, typically the average rate of return has been about 6 to 8% per year. And bonds typically give a return of 2 to 3% a year. And then stocks maybe about 8 to 10% a year on average. But however, no one knows where the market is heading. Of course, just because something happened in the past doesn't mean that it will happen in the future. But generally speaking, when we do look at the history, the market has trended upwards. And so that's where it's a great way to invest into the stock market rather than just leaving all your money in a savings account or even in cash.
So, what is your take on diversification?
Yeah, so for diversification, I think that this is really key and a great way for people to set them up for success over the long term. And this is diversification can really help protect yourself through the ups and downs of the stock market, or what we call bull markets and bear markets. And what you can do is that you don't want to necessarily put all your eggs in one basket. And what I mean by that is that when we reflect on the events of Nortel or even BlackBerry, for a period of time, they were doing really well, but then all of a sudden, their stock went down quite significantly. And unfortunately, a lot of people lost money. And so if you invest in many companies, you are essentially spreading out your risk. Because last thing you want to do is just invest in one company. Let's say, for example, and most recently we saw cryptocurrency or even lots of discussion around marijuana stocks. But then we saw people experience high amounts of volatility. And I know people who have lost a ton of money in that, and it can be really discouraging for an investor. And it could even scare them off, based on this one bad experience. So by investing in many companies, you can lower your risk and still reap the rewards of investing in the market.
Great. And you may have mentioned this already, but do you think is it important for an investor to diversify, especially starting with a limited budget?
Yeah, it's definitely doable for someone who's just starting out and may not have such a big portfolio. But even for myself, when I first started investing, I worked in the hospitality industry, making a very modest salary. And what I did is I just had those consistent habits where I automated my savings and I kept saving every month, even from every paycheck, to work my way up. And what's great is that you can invest in index funds, or what we call exchange traded funds, or ETFs for short, where really you've got one fund that has many companies in that one portfolio, and they can give you the average return of the market. And when you think about school, when you get a report card and your teachers say you're average, typically it's not so great when you're average. But then in the stock market, some people are known to try to beat the market, and that's when they're trying to get above average returns. But studies show that when you're trying to actively invest, a lot of people tend to fail at that because they're trying to time the market, which is tremendously difficult. So just try to be average and invest in index funds and exchange traded funds, and you will probably do better than most people out there.
Great. So tell me a little bit more about, I guess, diversification. So how would they go about diversifying in their portfolio, especially when they're starting with a budget or with a smaller amount, a dollar amount?
Mm-hmm. Yeah, so nowadays with online brokerages, it's really easy with a few clicks, you can easily buy one fund that carries hundreds, if not thousands, of companies in one go. And really simply, one is to think not just locally, but think globally. And most investors, they have a home country bias, meaning that they'll like to invest in their own country, such as Canada. And Canada is great. We're a well-developed country, but it's good to expand our options and invest in other countries around the world, because there's fantastic and thriving companies that have different specialties that Canada just simply doesn't have. Then another way is to invest in different sectors. So you can invest in, say, technology, healthcare, consumer packaged goods, financials, even REITs, and so on and so forth. And so this way, I guess you wouldn't really, it would be really hard for an individual to project which industry is going to do better than others in any given year. So why not just invest in all industries? And just like when you go to a buffet, you would probably want to try the different cuisines around the world rather than just sticking to one item on the menu, right? So
Yep.
that's my closest analogy, is just try everything.
Absolutely. No, along the same lines, Sandy, I love how you've mentioned investing in the importance of investing in different sectors, industries, and really be able to have that asset allocation and, in order to be diversified. Now, one thing that did come to my mind, and it sort of doesn't have to do with diversification, but it's about managing your portfolio. So should they, for example, as an investor, should they actually be looking at their portfolio on a daily, a weekly, a monthly, or maybe a yearly basis, just so that they can track their progress? Is there a specific rule of thumb that you would have?
Yeah, so I would say that, it can be very tempting, especially as a new investor, to keep your eyes glued to the screen and to track every single, all the moments of whether your funds are going up or down. But I can tell you from experience, it can be very nerve-wracking and cause an emotional roller coaster ride. So really, you don't need to look at it all that frequently. Maybe if you receive dividends from your funds, then you can go ahead and make sure that you receive them. It's great. But then otherwise, you can take a look at it maybe on a quarterly basis to see how they're doing. But really, you only need to rebalance your portfolio on a semi-annual or even an annual basis. And you can do this by simply sell off the funds that have overperformed and that have done really well, and then take that money and then you can purchase extra funds where they have underperformed in the market. And so this is where we're rebalancing things. And it also follows the classic theory or advice of buy low and sell high.
Great. That's great. Sandy, honestly, thank you for all the great insights today. I think the audience and myself as well, we have definitely learned a lot from you. Do you have any other tips that you can actually share with our audience today, just as some conclusion words?
Sure. Yes, I guess my final takeaway is that now that you have all of the information and knowledge, I definitely encourage the viewers to take action and to look into start investing today if you haven't already done so. Because if you feel like you need to wait for the perfect time to start investing, you're probably going to be waiting forever. Just like most recently back in March, the market plunge and some people got really scared. But then ever since then, we've seen a huge rally. And so now, it's a great way to start investing, whether it's, if you're too afraid to start lump sum investing, you can do something called dollar cost averaging, where you can spread out your investments over time. And then, you should keep track of your progress. But just don't be that person who just sits on the sidelines and doesn't do anything, because a few years from now, you're going to look back on 2020 and you would have wished that you had started investing today. And it's great to start small, get your feet wet, make a few trades. That way you can build your confidence. And then over the course of time, and hopefully there's a long-term duration, you will be able to grow your portfolio very safely and be happy with the results so that you can achieve the lifestyle that you deserve.
Great. Thank you, Sandy.
Okay, thank you, Ivy.